Well, as of course, this Mauritius FPI tax rules which have come to light.
Yeah, I mean, and maybe just maybe, because of the fact that this was done on March 7th, so many people moved to GIFT City, and we'll talk about it in detail with two very eminent experts. So needless to say, their opinion will be a lot more worthwhile. But so could that maybe just bring about a small caution for a day, if at all? But Tamanna, just globally for gold to do what it is doing right now on COMEX northwards of 2400, deep insider of geopolitics, and somehow it just seems that and it's right up your alley, but it seems that it's fraught with risks out there.
Yeah, I would say it's balanced overall, and yes, gold prices are a worry, but look at the kind of gold purchases by central banks. Look at China. When China starts buying gold in such large quantities, you're bound to skew the market. So yes, the other geopolitics of it, of course, is crude, and we'll talk a bit about that in a second. But if you look at the notes out this morning also on crude, pain maybe till Q2, but on the other hand, even as demand improves, the supply shocks remain. Israel is waiting for retaliatory attacks from Iran. US is saying it couldn't happen. But on the other side of it, I think those buffers to how much you utilize crude and crude derivatives are also growing, whether it's shale, whether it's the EV play by end of the decade, and even whether it's supply constraints. So on balance, I think maybe not too panicky right now.
Not too panicky, just that overarching fear that we are at valuations which are not necessarily cheap. There is geopolitics out there, and if the inflation print is anything to go by and the US yields are anything to go by, and if that is an indication of what demand will do, maybe we will not see crude prices retreating back to 70, 75.
Yeah.
And if they stay at these levels because of pure demand and supply cuts, then I don't know, something on the anvil makes you a bit queasy.
Your spidey senses are tingling. Your spidey senses are tingling this morning.
You get that about politics so much. Something that gets that to me about markets this time.
No, perhaps, no doubt. But I just want to spend a second on the FPI Mauritius news before we get to the global cues and why that's important and why it's our big story this morning. So essentially, and I'm putting this very, very simply, there was a new set of rules on March 7th. They've come to light only on Wednesday. It essentially means that FPIs that are based out of Mauritius now have to prove that they are there not just because of the tax advantages that Mauritius provides. So they have to prove that they've been around much before they started investing in the form of FPIs in Indian equity. That means you have an office, you have staff, you've been there for a while. Now, what's not clear is that if this becomes retrospective, that means you have to prove that you were there with all of these conditions much before. So that grandfathering bit comes in. And, so that's my take. It might spook the markets a bit today. Sentimentally, you might have some impact today. And you're going to have to look at that point. And, I've given those pointers as well. And if we could pull those up of you might have an initial kind of a reaction. Clarity is required on whether these rules are applicable retrospectively, and I think that shouldn't be left out in the open. The treaty shopping issue, which is at the core of this, that, you can't go to a place which has relatively better or more lenient tax rules, and because of treaties between India and that country, and then start investing like that. That needs a more comprehensive look. So we'll have to see what the impact is. Some great data, and I just wanted to pull this up very quickly, that Agam has pulled out, that as of Feb 2024, the highest amount of FPI presence in India was from Mauritius, second only to the United States. And we'll get that chart up for you. So you had about 26 lakh crores from US, and from Mauritius about little less than 5 lakh crores. Singapore, Luxembourg and UK are next in that line. So, those are some points to take. So maybe in that sense, you might have some impact today.
Yeah, but just a bit. And again, just dwelling for 30 seconds on this before we move on. So is it that material? That's the question that I am asking of this revised India-Mauritius tax treaty. One, large FPI sets from across geographies have moved to GIFT City or in the process of moving to GIFT City. So that is one thing which presumably lessens the impact. various estimates that I read, spoke to brokers, spoke to fund managers, not brokers really, and various estimates pegged the Mauritius-based FPI's holding at sub 10% of the overall FPI holding in India. So it used to be very large back about 15 years ago when the first murmurs of this came about. Now less than 10%, so not that dramatic as it used to be. And the agreement signed on 7th of March. So technically not new news, out in the open right now, but the FPIs and the Mauritius government and people investing through that route knew about this. Maybe some changes have already been taken. So could be interesting.
Yeah, could be interesting, and we'll talk more about it. Okay, let's get to global cues. We've spent a little time on the big story before we've gotten to global cues this morning, but because it's a key one that needs an explanation up top. But talking about what's happened in the US, remember on Wednesday, you saw a complete sort of very adverse reaction in US markets because of the hotter than expected inflation numbers. That retraced. You had a sharp rebound in the NASDAQ after the Wednesday sell-off, and what you're seeing on your screens right now is futures. Dow has been flat, the futures are also flat, but if you pull up the indices and see how NASDAQ has fared, it was fabulous. Now what's happening there is, again, the mega caps coming into play, and this whole boom that the AI flavor in sorts is back, and Apple was the shining star in that sense because of a Bloomberg report that said their new line of Macs are now going to be AI powered. Nvidia, the favorite when you want to play the AI theme, did well. So did Amazon. Amazon also had a fabulous run. So that's what's getting that NASDAQ up and about. But does that mean that inflation fears are gone? No, not at all. Look at the 10-year, and that becomes very clear. To the point that Niraj was also making, that the trajectory is only upwards. So you saw the 10-year go up to about over 4.45, 4.57% actually, because of the inflation number. Now, just a quick recap on that in case you missed it. For March, CPI was 3.5% month on month. Remember, the Fed wants 2. Even the core inflation figure way above comfort zone, month on month figure up 0.4%, more than expectations. So that's really what's hurting. Quick look at crude, and you had a bit of a retrace. So at $90 a barrel thereabout on the Brent. Now, a couple of reasons. The US has intelligence that there's going to be a retaliatory attack on Israeli embassies. That at least hasn't happened immediately, so maybe a bit of wait and watch over there, maybe a sigh of relief. So all of these factors coming in is having that impact on crude. No one knows where it's going yet. It's not looking very rosy, but right of this moment, we're not seeing any great panic. Quickly pull up Asia. And kind of a mixed morning is what we have seen. That's continuing. No clear trend over there. Implied open for India will be important to see this morning. And, considering all of those factors, and we're looking like we're in for a bit of pain. Could also be, because of the fact that you ended on a record high on Wednesday's closing trade. So a bit of maybe profit booking there, and overall factors spoking the market. Just want to quickly pull up fund flows before I hand it to Niraj for the trade setup of the day. And this is what boosted markets on Wednesday's close. FPIs were buying, so were DIIs, and decent figures at least from the FPI end of things. Today might be a different story though, Niraj.
Yeah, and again, some block deals out there, Massachusetts buying into Protean, and some other bulk deals also leading to this. So interesting, but could be a different story. Well, that's the point that I asked on a trade setup, kind of revised it a bit to ask whether is caution warranted if you are indeed an equity investor, leveraged or otherwise. So US sees a missile strike by Israel by Iran and proxies as imminent. So first sign of danger, you're seeing gold and crude showing signs of that. Crude prices continue to hover around that higher levels of $90 per barrel on the Brent side. So is caution warranted, I ask? I mean, crude prices at 70 is a different kettle of fish. 90 and above is a different kettle of fish for India. The latest US CPI print raises the doubts on the Fed pivot in the June policy. Again, something that might not please the street. In fact, Nomura in its note today has written, and Sonal Verma and colleagues have written, that what if there are no rate cuts this year, and what happens to Asia and Asian banks' reactions as a result of this? Very interesting piece. Some point of time we'll talk about that as well, and hopefully get Sonal Verma today or Monday. But yeah, this is something that is very keenly watched out for. Nifty PCR at 1.32 is closer to the higher end. Though I must say PCR nowadays behaves very, very erratic. It was 1.08 to 1.32 in a matter of 24 hours. So difficult to really call it a very higher lead indicator, but certainly a bit of a discomfort there. Unlikely though that in the tax treaty revision will have a very large impact, but that also continues to remain an overhang maybe, and our experts will be best placed to talk about it. But yeah, and therefore the question about whether caution is warranted on the Indian markets, not just for the day, maybe just maybe for the near term until these clouds clear out. So that's technically the trade setup for the day today.
So when you say not have a large impact, that's longer term, right? What about today? My sense is that you might see a bit of a downtrend today because sentimentally people are still trying to figure that is this retrospective or not.
Yeah, which clarity is not known, and hopefully Pranay Sehta and Dinesh Kanabar will be able to give us some inkling about that.
They will, but frankly the government has to come out and say this.
Yes.
And if this was happening on March 7th, then we also need to ask what's taken so long to put this in the public domain. Fine, you have new rules coming in, but let's have transparency.
Yes.
I mean, the market and equity participants and investors deserve that. Now, having said that, let's get to specific stocks and what's on the radar. Now, my colleague Vishwanath Nair broke a story on Wednesday on Vodafone's FPO. That story has been confirmed. That news break on NDTV Profit has been confirmed. And now we know that the board will be filing an RHP in connection with that FPO. It's about 18,000 crores. The bid and offer opening date is April 18th, closing date April 22nd, anchor investor bid April 16th. So you might see some movement on Vodafone today. Of course, the big question on how successful that attempt at raising 18,000 crores is going to be obviously remains, but we'll wait and see. Very quickly, Dr. Reddy's is another one that I thought we should talk about. Now, they have this interesting product, which is a drug-free migraine management device. It's called Nerivio. They launched it in India in 2023. It's launching now in Germany through their subsidiary Beta Pharm and marks their entry into digital therapeutics in Europe. Niraj, why I found this interesting is because if you see that device, it's actually an armband. And migraine is one of those pesky things that people struggle with. So it's an armband and it helps apparently with your migraine. So it could be an interesting product and also a foray for the company into devices in Europe in this sense. CAMS is the other one I thought we should talk about. They've got the RBI nod to operate as an online payment aggregator. As it is, this is a company that's been doing very, very well. Stock market does well, CAMS does well in terms of fundamentally, of course, where their numbers go. And now this is another trigger. Their subsidiary, which is going to front this, so to say, CAMS Pay, has registered more than 1.2 million mandates for UPI. My only question, though, is, are there enough margins in this kind of a space? UPI doesn't really leave anything on the table for the facilitators, but that would be interesting to see as well.
So those are a few. I'll watch out for the results today. Of course, TCS and Anand, both of them likely to come out post-market hours. But on TCS, interestingly, there's been short covering seen since March end. The OI is down 15% and the stock is up 2% since that period. And therefore, do keep a keen eye on for TCS. There has been a bit of an upward movement ahead of the numbers, maybe for a clutch of IT names, but TCS in particular. So watch out for TCS. $75 million OI is slightly above its one-year mean as well. So shorts still existing despite the short covering already seen. So watch out for TCS in particular in the session today, ahead of the numbers as well. And remember, on the closing show today, we'll do a deep dive into what are the things that could move the needle on TCS and the FNO positions as of that point of time at 3 p.m. So TCS is something we'll keep you updated with. We'll talk about the listing also in a bit. But first, Phoenix Mills Q4 update. The total consumption up 27% YOY at 2,818 crores. The gross retail collections are up 37% at 791 crores. This has to go out as a very strong update for quarter 4. As a result of which, I think their annual numbers also came to about 20 to 23%. Not a bad number at all. I mean, we're talking about consumption in the K-shaped curve. And I think for Phoenix Mills kind of justifies this, right? Essentially, you're talking about the retail collections, not about the hotel revenues. And this seems to be a good number. So watch out for Phoenix Mills in the session today. I don't know if you've been buying. I certainly haven't been, but clearly there's some strong momentum there.
No, absolutely. Yeah. And just to add to and I would say underline the point that you made about where the whole question mark remains on the consumption story. Are people going out and buying? Well, at least Phoenix Mills shows that they are, and this is no longer just a very urban premium kind of a play. This shows overall demand very much there, at least in some pockets. Yeah.
Phoenix Mills certainly enjoying that. And Metropolis was interesting. So the core business revenue grew by about 15%, but also they repaid all of the debt, resulting in a debt-free status as of March 31st. Now, maybe this brings about a reaction. Remember, Metropolis has climbed a long way from 1,200 about a year ago to 1,800. So there has been a retracement in some of these diagnostic companies as well, or the last 1 month, the last 1 year. Let's wait and watch if there is some more upticks on the back of this announcement today. So these are the first 3 on my list. There are some others too, Tamanna, but anything else that stood out for you?
Yeah, I just wanted to talk about the Tesla story. And there's this interesting list that our colleague Puneet put out. And going through that, adding maybe a couple of more, which I thought were possible beneficiaries. So in case you missed it, now there's a confirmation that Elon Musk will be coming to India. He'll be having a conversation with Prime Minister Modi. It's coming at a time when we're expecting a concrete announcement of Tesla's plans for India. Now, anything they do in India will have to have a Make in India component. And that means a great opportunity for a clutch of companies in that space. We don't know exactly which ones, obviously, those announcements haven't happened, but those that are well positioned and maybe could see some play as early as today, or this is a trend that you should watch out for. So Sona BLW is one of them. Already has some work that they're doing for this car maker, but 28% of their revenue is already from the EV space. Sansera Engineering is the other one, 18% of its order book from its EV space. Motherson Sumi, Endurance Tech, Uno Minda are those that are positioned. I thought I'd add a Varroc Engineering as well. Varroc is another interesting play for something like this. So great times, I think, for Indian auto anch players as well, if the big boys come in and then have to do at least something Make in India.
Yeah, I mean, I'll be interested in seeing what SKF India has to do as well. Is the sole supplier of bearings to Tesla worldwide. And therefore, suffice to say that SKF India would possibly benefit out of this as well. So very interesting as to what's happening. Rolex is making a dedicated line for SKF USA for Tesla, being the leader in the ball bearing segment. So Rolex rings, I mean, trades at 18, 20 times. So some of these companies are not exorbitantly priced as well. So that's pretty interesting too. Watch out for Maharashtra Seamless. Has received an order worth 674 crores from ONGC. So that's to be watched out for. And a couple of other things. So GQG has raised stakes in the Adani Group between Jan and March. And just a small table which depicts where is it that they have bought in. Because remember, they were existing shareholders in a big way, and they've only upped their stakes, so to say. Adani Energy Solutions from 2% to 4.53%, Adani Power northwards of 5%, Adani Ports, Enterprises, some upticks there, and Adani Green, some uptick there as well. The only one where they have gone down is Ambuja from 1.83 to 1.68. So that's one stock where they pulled back, but otherwise, they've upped the game on the Adani Group. And lastly, do we have our guests? We do have our guests. Very quickly, just brokerage notes, just want to mention these. The Goldman note on CDMO companies. Laurus has been very active the last few days. Goldman says that Laurus is a sell and a target price of 350. Very interesting. We'll get in our colleagues a bit later on the show to tell why this is the case. And a call on Newland Labs, a buy with a target price of 9100. That's nearly a 50% upside. So do watch out for these as well. So these are a few stocks that you need to keep an eye out for. But I think we have our guests, so let's go across to them. Yeah, absolutely. Just one quick mention of Bharti Hexacom before we go up, just because it's the IPO of the morning. It's an exciting one. And this there's already a note on it. JM Financial has already initiated coverage with a buy. So I would just look at Bharti Hexacom this morning. The issue price of 570 and JM Financial has already got a target price of 790. Remember, they were subscribed nearly 30 times. So
that's going to be an interesting one. But let's come to the big story this morning. Pranav Saita, National Leader of International Tax and Transaction, with us today. I'm also speaking with Dinesh Kanabar, CEO at Dhruva Advisors. Welcome to both of you, and thank you so much for joining us. Let me start with you, Mr. Saita, just to understand, why is this a big deal? And should investors who are coming in through the FPI route and based in Mauritius, should they be worried?
So very quickly, this is an important announcement. The formal notification is expected. But this is important because for several years, Mauritius had really resisted introduction of the principal purpose test, which is through the multilateral instrument becoming applicable to the Mauritius-India Treaty. And what that essentially means is that any foreign investor who's invested into India through a Mauritius entity, in order to avail of the benefits of the Mauritius-India Treaty, the investor will now have to demonstrate that the principal purpose of investing into India through the Mauritius vehicle was not for the purposes of tax mitigation. And not only the principal purpose, but if one of the principal purposes is with that objective, then the treaty benefit could be denied. So that's the reason why it becomes important. This has been the case for some time through a multilateral instrument, but the Mauritius-India Treaty remained unamended. Now, with this particular amendment, it becomes important that they are able to demonstrate that one of the principal purposes was not to avail of the benefit of tax mitigation in India. The other is that there is some uncertainty in the language of when this becomes or when this would become effective from, and whether it would protect even grandfathered investments, meaning investments made before 31st March 2017. When it becomes effective, clarity and certainty on that front would be very welcome. And also the fact that it would not impact any grandfathered investments. For public markets, what is essentially important, especially for FPIs, is if there are holdings of shares in an Indian company pre-2017 March.
All right, we seem to have lost that feed at a very, very important point. I was waiting to hear the end of that sentence, but we'll get Pranav Saita back and get that. What happens if you've got holdings before 2017? But let me come to Dinesh Kanabar for his opening comments. What we're trying to understand today and what our viewers would try to understand, that is this a negative impact for Mauritius-based FPIs, and to what extent will they be hit?
So two parts to it. First of all, India is a party to the OECD amendments, and one of the amendments is that every investment into using a treaty should, as Pranav was explaining, meet the principal purpose test, meaning thereby that if you are using the treaty of another country only for availing tax benefits, then the treaty should be denied to you. So if there is a US investor using a Mauritius treaty to invest into India, and the principal purpose of that is found to be only to avoid taxes which are legitimately avoidable under Mauritius-India Treaty, then the treaty benefits can be denied. Now, this principal purpose test is something which India has been renegotiating several treaties, and in several treaties it has been there. Mauritius is now going ahead and implementing. I think the real point is the point which Pranav mentioned in the passing, which is the applicability of the treaty. The wordings of the protocol which has been entered into to amend the treaty suggest that this amendment will apply to all existing investments and to all the past years. And that is not while that is not very happily worded, knowing how the tax office is likely to implement it is to go back and say that even if your investments were made way back in time, if the examination of that investment is coming up now, we will apply the principal purpose test. We will not grant you grandfathering, and therefore to that extent you are open and vulnerable to a tax payment in India. So to that extent, all FPIs could get very significantly impacted as a result of this amendment.
Sorry, Mr. Setup, good morning, Niraj here. Is that your assessment as well? Because, Mr. Kanabar seems to believe that it seems that it could be retrospectively applicable. I thought we moved on beyond that from an Indian landscape for a long time. Is that your assessment as well, Mr. Seta?
That is right. That could be a possible interpretation. The protocol is not very happily worded. I would strongly feel that this was unintended, that they intended to make it applicable only prospectively. However, the language leaves much to be desired, and therefore I hope that some clarification to this effect is promptly issued so that there is no uncertainty in the minds of investors. And I would feel that that's how, in any case, courts would interpret this particular protocol. But that's for the future. I think an immediate clarification would be very, very welcome and helpful.
Kanabar, pending that clarification coming in, how are clients likely to kind of react to this? Also, a word on that particular aspect, because a lot of estimates that informally we spoke to some fund managers, etc., and they mentioned that the quantum of FPI investments inbound through Mauritius route has come off quite significantly, not just because of GIFT, but even ahead of GIFT, and now because of GIFT even more.
I would agree with you. I think the use of Mauritius for investments into India has declined and has declined considerably. That said, there are two parts to it. First is this issue regarding retrospective amendment, which you raised earlier. And I think Pranav is being charitable when he says that it's just the language which could be interpreted. The way we see tax office actually interpret that is really something which is likely to be hugely negative. And to say that government is signing something today and which needs a clarification here and now itself would seem to suggest that maybe it's the intention of the government to really reopen past. And that's what it would appear to me to be. But what it therefore communicates, the question which you asked earlier, Niraj, that we seem to have moved past retrospective amendments. Are we really reopening cases to go back and say that foreign investors again are seeing a bout of uncertainty? So to your question, while the Mauritius investments have reduced considerably, the question is, how does India look at its tax regime and what is the stability that we are given? And I would very much agree with Pranav that an urgent clarification to say that there is no retrospectivity intended is going to be very, very critical. Otherwise, we are sending out wrong signals.
Wow.
You know, just one point, Mr. Saita, and you were mentioning that before you got cut off. I just want to go back to it, and maybe we need to reiterate, underline it, that what does this mean for investors who have been there before 2017? Because right now, people who are watching, investors who are watching, are going to try and glean what the immediate impact is. Hopefully, those clarifications will come. Ideally, if there's a treaty which is signed on March 7th, we shouldn't be waiting till April 11th to somehow find out. So, you know, how do you look at both those points?
So, in respect of investments made before March 2017, which are unsold yet, and which are yet to be exited from and gains to arise from, so far as such investments are concerned, I would feel that the level of such
something with that answer. Whenever Mr. Saita starts on it, his feed goes off. Do I have him back on? Can you hear me?
Have him back on.
Can you hear me, sir?
Yes,
yes, please.
Yes, very much.
Now it's a cliffhanger. We have to finish the story. Yes, please.
Sure. So sorry for that again. So I would feel that the grandfathered investments may not be too many or may not be significant, because most of them would have been exited to by 2024. But to whatever extent they still hold acquisitions made before 2017 March, there is again some uncertainty whether the grandfathering, which was guaranteed when the GAR provisions were introduced and when the treaty was originally amended in 2016, whether those would continue despite this principal purpose test being now introduced. And I would feel a clarification on that would be very welcome, because that would be otherwise a very real technical problem. Less for public markets, because not too many investments pre-17 may still continue to be held, but also more for private markets and private equity, etc. investments as well. Also, when it comes to investments in Indian markets, public markets, investments in units, for example, of REITs, InvITs, etc., or investments by feeder funds in Mauritius into mutual funds, which units were not even post-2017 acquisitions continue to qualify for the benefit of the treaty. those also could be impacted by this particular protocol which has been assigned, because those continue to be exempt or non-taxable under the Indian law, read along with the treaty, so far as they are not shares. So far as non-shares is concerned, even investments made post 2017 continue to be non-taxable. But if this protocol were to be implemented, then one would need to demonstrate that one of the purposes was not to avail of the tax benefits in India. And that becomes a bigger burden for taxpayers to claim the benefit of non-taxability in India now.
Well, low burden of proof on the tax authorities before they deny treaty benefits, but a high burden on taxpayers to prove that the arrangement is kosher, is what somebody else mentioned this as well. Mr. Kanabar, simply put, if they, okay, so in a nutshell, if the authorities come out with the clarification, hypothetically, that this is not retrospective, is then the impact mitigated, or even then the impact is high?
No, so two parts to it. First is the clarification is in respect of what items. So if you are talking about clarification in respect of investments made up to the date of protocol, I don't see a challenge. If that is clarified, that all future investments are the only ones which are going to be taxed, then people will do their investment portfolio, will rejig whatever they need to, or plan for those taxes and move on with life. The clarification has to therefore be very categorical in terms of its ambit. The way the clarification reads or way the protocol reads today, it seems to suggest that any assessment year, even prior to the protocol, would be subjected to tax. So it's the way the clarification comes, which is going to be very critical. And if the clarification is categorical to say future investments, no past investments to be impacted, then there would be no significant impact. Then people would sort of, as I said, either calibrate the tax impact on their investments or would restructure themselves.
Okay, and Mr. Seta, the same question to you. It could be your interpretation could be different, but if they give the clarification, is the impact largely mitigated? Assuming that they give the clarification that until the date of the protocol or until this revision has been done, it is not retrospectively applicable. Does that mitigate the impact completely?
So let me put it this way to make it very clear. I don't think I expect a clarification that all investments which are made up to the date of the protocol signing will not be impacted. What I do expect is that all sales, any capital gain accruing arising on a sale after the date of the protocol being signed and becoming effective are only impacted, and not any exits, any capital gains arising before the date of the protocol. So I don't expect that investments made only after the date of signing of the protocol will be impacted. Even investments made before the date of signing of the protocol will be impacted, so long as the exit or the capital gain event arises after the date of the signing of the protocol. That is the clarification that I expect will be made, and that I think is the intention. But since I heard Mr. Kanabar saying only impacts investments made after the date of signing of the protocol, to clarify, that's not what I meant. At least I don't anticipate that coming through. That's one. And if that happens, then I would, and second, I expect that if an investment was made before March 2017, then whenever the exit happens, it will always stay grandfathered. That is the second clarification that I would hope to receive. So that's where we are. And if both these are received, I think largely the impact would be minimal. It would then impact very few investments made before March 2017, which also would be then grandfathered. So it would really impact maybe units, etc., holders who are not holding shares, but who still have public market impact. That then would be very limited, I think, of this protocol.
Yeah, let's hope for those clarifications to come in, and also the question about why put out something in a way where you create so much confusion. There really is no need for this kind of a panic. But, we'll wait and watch for what kind of clarifications coming. Thank you so much, Mr. Saita, Mr. Kanabar, for speaking with us today. I just want to pull up that data point once again of how much, and this is NSDL data, as of Feb 2024, how much quantum is actually coming into India. And Niraj made the point that it's come off. It has come off, and in that order, if you see, Mauritius is actually second because it's higher than what's coming in from Singapore. So the second largest inflows in that sense, or second largest assets under custody are from Mauritius after the US. And there's a significant gap. Of course, US is the largest, but Mauritius is no mean number. So the order would actually be US, Mauritius, Singapore, Luxembourg, and then UK. All right, we'll take a very quick break. I want to quickly check the implied open before I get into that break and see what kind of an open we're set up for. And it's going to be a bit of a pain, at least right in the beginning of trade. Very quick break. How should you play the market today? Milind Vaishnav of Gemstone and Nirav Asher of Latin Manhala Securities will be speaking with us. We'll also be talking to Kush Bora and Jitish Pai of Nirmal Bang on the Q4 TCS review. So a lot lined up for you on the show today.
Welcome back to India Market Open. Well, we are taking stock of the futures and options space at the moment. Let's see how things have panned out last Wednesday and what kind of cues they can offer for us moving into this trade this Friday. Now, we saw the Nifty advance by around 0.5%, very little change in open interest, but the Bank Nifty, on the other hand, did see a 9.5% increase in OI towards what we think are fresh longs, considering it's, closed just short of the 49,000 mark. In the options market, since the Nifty moved higher, we started to see a little more writing around the 22,700, 22,800 calls, puts. And in terms of your overall open interest distribution picture, your max OI has risen now from 22,500 to 22,700 puts. And on the higher end, your call max OI has moved from 23,000 to 23,200. So the entire range has shifted higher. But in terms of all the stocks that we are keeping an eye on, well, we have longs in United Spirits, Federal Bank and SRF. And in terms of stocks which saw unwinding, we saw about a short covering for HPCL, Apollo Tyres, Exide, MCX and Tata Chem. But let's take this forward into what we can expect going forward. Well, we have with us Milind Vaishnav, he of Gemstone Equity Research, who's joining us on the show. Milind, thank you for joining in. Well, let's start with your view on the benchmark. I believe you have yet another short strangle that you're playing. Why?
Yes, Agam. Very good morning. I see a couple of things happening. To begin with, I expect Nifty not to give any any runaway kind of rise, and at the same point in time, I also don't expect it to slide or show any major downsides as well. Largely, by and large, I expect Nifty to stay in 22,400, 500 levels on the lower side and 23,000 on the upper side. I expect Nifty to stay by and large within this range. Moving to Nifty Bank, I see it staying relatively stronger than Nifty. So long as it is staying above 48,700, all technical rebounds will play out far better in Nifty Bank as compared to Nifty. But Nifty, by and large, I expect it to stay within this 500 to 600 point range. Remember, we had a truncated week. This week was truncated, and the next week is truncated as well, with Wednesday being a trading holiday. So I expect this range playing out. Short strangle, yes, since I expect the markets to stay in the range, I am playing out a short strangle by selling 23,100 call and 22,500 put. I'm not spelling out the exact premium because there would be some significant change once we are, since we are operating after a day's gap. But by and large, again, we expect 1.5 to 2% yield on this trade.
Right. Well, that's an interesting yield as well. But let's move on and talk about Kotak Mahindra Bank. Milan, this is the other one which continues to move in a range. What's your view here?
Kotak Bank has been trying to confirm a reversal or some fresh momentum can be expected in Kotak Bank. We can play this out by using a call spread. We can buy 1,800 call and sell 1,900 call, and maximum profit should be around 22,000 to 23,000 range, and max loss being capped at around 13,000 to 14,000 rupees. As a matter of stop loss, one can exit the trades if Kotak Bank spot price slips below 1775.
An interesting one to play out for Kotak Mahindra Bank. Of course, they're playing a spread there. But on that note, Milan, taking a moment to thank you for joining us and taking us through your views on the markets. And with that, it's back to you, Tamanna.
All right, thank you for that, Agam. Now, the focus this morning is all IT. We're going to be kicking off results season with the big one, TCS, of course. What can be expected? Is Q4 going to, sort of set the stage for the rest of the pack? Better than expected? Your discretionary spends still continue to be a problem in the US. AI has become the focus. Breaking all of that down is now Girish Pai, consultant research analyst, IT services at Nirmal Bang. Girish, very good morning to you. Great to have you on India Market Open. Now let's talk TCS. Revenues are expected to rise 1.4%. EBIT may rise by about 2.8%. Overall, do you think that this is going to be a quarter where we get some clarity on how the tide is changing for the IT industry and, of course, TCS?
First of all, thanks for having me on your show. So if you look at what happened in the third quarter, 3Q FY24, the sentiment was quite negative. The corporate commentary going into the quarter was that the furloughs are going to be deeper and wider. And what happened actually was that things weren't really that bad. And post the quarter, the commentary for 4Q has been muted, but not very negative. So I think for the current quarter, for the tier one companies, I'm expecting between 0 and 1% kind of sequential CC revenue growth for the larger companies. For the smaller companies, the mid-cap companies, I'm expecting something like 2 to 3% kind of QQ growth. And in terms of commentary, if you look at 3Q, there were some companies who were talking of some green shoots. So for instance, TCS itself talked about green shoots in the BFSI vertical. Wipro talked about a pickup in order inflow on the consulting side, kind of implying that discretionary spending is kind of coming back in some fashion. Now, we need to see whether that kind of commentary, the positive commentary kind of broadens out and you see more people talking about it. But if you hear the global players, if you hear what the other players in the US and elsewhere have kind of indicated in their calls post their December quarter results and have given kind of their organic growth guidance for 2024, they've been weaker than 2023 actually. So it's a very mixed picture. We need to kind of watch out for whether the discretionary spending pickup that some people are talking about is going to widen out. And also watch out for the guidance that companies are going to give for FY25. The general sense is that FY25 is going to be better than FY24 by not much, but let's see how that kind of pans out.
What are the big factors and management commentary that you're going to be looking out for, Girish, today? Of course, BSNL ramp up is going to help. The Aviva deal is going to help. But what are the top, I would say, 2 or 3 things that you will be wanting to hear from the management?
Yeah, so TCS has already indicated that FY25 is going to be better than FY24. So based on my numbers, FY24 growth would be about 4.2% in US dollar terms. Now, how much better can this growth be for FY25 is something that we're going to watch out for. Now, I'm not sure whether TCS is going to come out and give a numerical commentary, but how much better it is going to be is something we're going to watch out for, some qualitative commentary on that. The other thing that I would watch out for would be, whether discretionary spending is kind of widening out just beyond the BFSI space that they talked about in the last quarter. The third aspect would probably be salaries. So if you look at last year, except for TCS, every other tier 1 company actually pushed back salaries by anywhere between 3 to 6 months. A lot of the salary increases came through in the third quarter. Now, I'm just waiting to see whether TCS continues to give that first quarter salary hike across the board, or whether that gets postponed a bit because of the demand environment that we're currently in. So I would probably think those are some of the key things that I would kind of watch out for.
Girish, to your mind, good morning, Niraj here. Just one question to your mind. What would be the biggest needle-moving development/commentary in TCS or any of the others as well? What is that one key metric, if there is one such key metric, that you would keenly watch out for?
So obviously, discretionary spending pickup commentary, if that is a broader theme that's kind of playing out in the commentary of various companies. The other thing I would watch out for is whether hiring picks up in a material way. So there's been this jobs peaks index of InfoEdge, which kind of indicated in February that there's a little bit of pickup. Now, some people say this is a seasonal number, seasonal pickup that one typically sees in a year. Now, that could also be, it will probably forecast that something is picking up on the demand side. Now, on the demand side, what I do believe, based on whatever I've heard from the companies, is that it's going to be more back-ended in FY25. Now, the key thing that I would watch out for is that what is going to drive that back-ended demand pickup? Is it going to be interest rates in the US, or it's something else? Because interest rates in the US, the needle has swung from something like 6 to 7 cuts to today we are probably sitting at 2 to 3 cuts. So will a 2 to 3 Fed funds rate cut imply that customers are going to come out and start spending? So those are some of the things I would kind of look out for.
An answer before we let you go. I heard you say that some of the people are saying it's seasonal. You know this space better than most. Do you think this uptick in hiring is seasonal?
So I think it's a little early to see any kind of material pickup in hiring. I think already there are some companies which are sitting on, I would say, utilization levels which are not at the peak. For instance, Infosys is still at, I think, 80 to 83% if you exclude the trainees. That number was at the peak somewhere in the 88, 89% territory. So there is a lot of headroom for utilization improvement in some of the companies. So it may not be a broad-based pickup in hiring that we'll probably see, at least in this quarter. I think that hiring pickup is probably a couple of quarters down the road.
It is so good of you to take the time out and join us this morning during the course of the earnings season. Look forward to talk to you more.
Sure. Thank you.
All right. That's Girish Pai with his thoughts. Let's get in. So that's IT, and watch out for the metrics that Girish mentioned. Remember, TCS has seen a bit of an uptick from the last expiry. So keep that in mind. For TCS in particular, the results come out post-market hours today, very likely. Let's get in our technical and fundamental experts for the day. Kush Bora, founder of kushbora.com, and Nirav Asher of Latin Manala Securities. Both of them join us on the show. Gentlemen, thanks so much for taking the time out. Kush, we are definitely going to start off lower today. What kind of trades, therefore, do you have? Do you initiate after such a, let's say, 150-point downtick?
Sure. Hi, Niraj. First up, a very good morning to you.
Thank you.
Well, look, let me put it this way. We had the target of 22,800 on the Nifty for the month of April. That was our second target. We came strikingly close to it. So for all practical purposes, we'd consider it achieved. Now, here's the rub. If you see on the weekly setup, the momentum indicators are indicating some sort of a negative divergence. So anyway, beyond these levels, we are not entirely convinced about the kind of momentum that the index could have, going forward. While we do maintain a bullish stance, and 23,000 does look like a very likely number, as the next target, what we would suggest is a buy on dip strategy. And, as it were, the gap down opening is actually sort of a blessing, where the index is opening close to the support level, so you don't have to chase these chase these, the upswings that you are getting. So for me, these dips are a buying opportunity. 20 to 500, 20 to 600 is anyway a support zone for me. So with this gap down, yes, I will look for buying opportunities. Maybe not in the first 15, 20 minutes. I'll let the market see if the fall is accelerating further. But if it does look like it's stemming the fall, 20 to 600 is a support zone. I will go out and buy for the targets of 22,750 and about 2850 as well. 22,850 as well. So this dip is a buying opportunity for sure, and more so for Bank Nifty.
So there is a buying opportunity here. Good morning, Kush. The question is, what would you buy specifically? What would be your top picks today?
Well, a couple of stocks. There are two sectors and quite divergent. My picks come from two divergent sectors. One is the power sector. Now, everything that's there in the power sector has been doing well, will continue to do well. That's the kind of setup we are seeing. So NLC India is something that we've got on our radar. This stock, gave a breakout on Wednesday. There was a nice volume uptake as well. So 245 and 249 are the targets that we're looking at in the near term. 237 is where I would place my stop loss. The other sector is a bit of a recovery play. The entire chemical space is doing well, but RT Industries in that pack has been the leader, continues to do well. Again, on Wednesday, similar setup, volume backed up move here. So 750, 765 are the near-term targets, and 720 is where I would place my stop loss.
What about PVR? I just wanted to quickly get your take, Kush, on a PVR because of this, I would say, mind-boggling CLSA note which has come out. They've retained a buy with a target price of 2,280. That's a potential upside of 65%. And of course, they've given their reasons. It's a sector leader in a consolidating market, etc. Occupancy should rebuild in the mid-long term. For multiplexes, they think the current content challenge is not structural, etc. But I'm just wondering if you're seeing any potential of that on the charts, Kush?
So, Tamanna, I'd just like to perhaps do a dipstick kind of a survey. I mean, do you still prefer to go and watch movies in the theater, or
very
is it
rarely.
Let's wait here?
Very rarely.
Exactly my point.
Only
exactly
maybe for a Dune or something, but very rarely. Yeah.
Yeah, and I know I'd perhaps go in for a Marvel movie. I mean, not otherwise. But other than that, what we're seeing is that there is this behavioral shift. Although that's not my domain per se. But even from a price standpoint, if I see the bias is squarely negative, there is a rebound attempt from that 1300 level where back in April of 23 also we rebounded. So for me, I will wait for a couple of crucial levels to be taken out. The most important one being 1550. If that is taken out, I might play this as a trending momentum kind of a play. But up until then, not really, not too convinced on the up move that we're seeing recently.
Niraj, why don't you participate in this quick dipstick that Kush has?
The last one that I saw was Top Gun Maverick.
Oh God, that was really old. That's the last time you went to a movie hall.
Yeah.
Okay. So fundamentally, at least Niraj in this dipstick is not pointing towards that optimism. Nirav, I have to ask you, it's a Friday. Any plans to see a movie this evening in a PVR?
Yeah, first of all, good morning and thank you for having me on your show. So no plans as of now, but maybe I'll catch up with some IPL matches. That will be better.
That will be better. See the flavor.
So coming to the point of what the question actually was, do you see any merit in this CLSA note on PVR, which has retained a buy with target price of 2280? Obviously, they're planning to add a lot of screens, 150 to 160 a year. Nirav, you see merit in that story?
Well, it's quite possible because we are a country which loves Bollywood and cricket, and I think we've seen both these sectors grow from strength to strength. So watching the movie in PVR, it's an experience of a kind. So I think people would not hesitate to spend money, and the demand is definitely there. So I think there's definitely merit in this investment argument as far as PVR is concerned.
Okay, well, maybe some merit in that argument, but I think that's a blue sky scenario to my mind on that CLSA node, really. Let's wait and watch how it shapes up. By the way, what is not probably a blue sky scenario post Elon Musk's tweet is global OEMs coming to India. The big one, of course, is announcement around a potential imminent announcement around Tesla and other global OEMs. So which are the stocks that benefit out of this? Puneet, my colleague Johnson, with some synopsis of what are the stocks that could potentially benefit. Puneet, I mean, global OEMs notwithstanding, everybody's excited about Tesla. So let's say that. I'm asking this question. Who benefits if Tesla invests into India?
Well, thanks for that, Niraj. So yeah, there are certain auto component makers that are set to benefit largely from the entry of these auto OEMs in India, these global auto OEMs in India. And with the localization, one of the key clauses in the new India EV policy is the 25% and 50% domestic value addition, which means the components will have to source locally. So we've looked at 5 key stocks here of the auto ancillary space, which will be key, which could be a key beneficiary, starting with Sona BLW. Now this stock, the company has been huge in the EV space ever since its listing and has given great returns for its shareholders. Currently, 28% of its revenue is already coming from the EV space, and the trajectory is just upwards from this level. The second one we're tracking is Sansera Engineering. Now this mid-cap auto component maker has been on a tear with great revenue numbers as well as stock price performance. Currently 18% of its order book is already coming from the EV space, and this one too will be a key beneficiary once the global OEMs come to India. The third one is not a surprise. Motherson Sumi, the parent company listed over the last couple of decades, have done really well. Now, the company has roughly 21% of its revenues coming from India currently. And with the gloomy outlook that the company has pictured over the last couple of years in its big markets such as Europe, India is set to take the baton further in its total revenue, and this will be one of the key. Now, they've already partnered with the likes of Tata as well as Mahindra in their new launches, but someone like a Tesla coming into India will be a key trigger for the stock. The fourth one we're tracking is Endurance Tech. Now, the company has largely been focused on the two-wheeler space, but the diversification has come through in the last 4 to 5 years, as well as orders into EV have been picking up. So currently, roughly 8.5% of its total orders that will be executed in the next 1 to 2 years is in the EV space, and we'll be tracking this one very, very closely. Finally, Uno Minda. Now, the company has been very evenly balanced between the two-wheeler and the four-wheeler space. Currently, 49% of its revenue comes from the four-wheeler space, and they don't have any kind of exposure in its revenue to these global players. So, entry of such players into India will be a key trigger for the stock as well as the margins going forward. So, these are the 5 stocks that we've picked in the auto components that could benefit from the entry from the likes of Tesla, and that's all we have for that right now. Back to you.
Uno Minda has a bit of news as well today. Maybe I would add to that list of Varroc Engineering. Niraj was talking about an SKF. So a lot of play there. We're going to ask our experts on the other side what they think about this Tesla play. Just on Uno Minda, a bit of news as well. So you could see some reaction. They've secured a 94-acre land parcel in IMT Kharkhoda in Haryana. This will be done with a capital outlay of 542 crores. It's a groundbreaking ceremony which they've done for a greenfield alloy wheel plant. So a bit of expansion there coming in from Uno Minda as well. But I'm excited to see what Tesla makes over here, because they're notoriously picky about outsourcing anything. When Tesla first started, the problem was Musk wanted to make everything himself. At some point he realized you can't run a company like that.
Yeah.
But they're very, very picky.
But something tells me, just by the virtue of the fact that he's tweeted it out, meeting Prime Minister Modi, etc., the plans could be big. I may be just biased.
No, he'll have to. He'll have to. He won't be allowed to enter without it. Yeah. So that is very clear. We'll take a very quick break, but we'll be back now with pre-open rates, talking more about Tesla and who benefits, all of that and more on the other side.
Back with India Market Open. About 18 seconds left for the pre-open session. Remember, we'll start off soft. And just want to mark something that a very prominent mind put out over the weekend when, or rather in the holiday, and we'll come to that in a moment, because when Uday Kotak speaks, we should kind of listen. So we'll kind of bring that out as well. But first, the pre-open rates and the implied open suggest that we'll start off lower. These rates will change, so ignore these actually. Let's just give these rates a chance to settle. Maybe bring the conversation back before we get to what Uday Kotak's warning was. Maybe bring the conversation back to something that we were talking about before the break, which is an imminent entry of Tesla and what it could do. Now, Nirav, I'll first come to you. Have you guys done some analysis on suppliers to Tesla currently as well, and can they potentially benefit, maybe conversations with those companies, etc.? Anything on your mind? You're on mute, Nirav, I think. Please continue.
I'm sorry. Yeah, so whenever such a giant plans to make an entry into a country, naturally there is going to be the issue of transfer of technology and who stands to benefit. But for that, you should have the incumbent players, the existing players. They should have the necessary capabilities to demonstrate and to execute the work on behalf of giants like Tesla. So coming to your point, I think companies like Sona BLW or the likes of Mothers and Sumi, they are likely to benefit in a big way because they have a proven track record. We've seen Sona BLW do a lot of work on the EV front. They are focused on electric vehicles and they have the necessary technologies over there and the capabilities. At the same time, we have Mothers and Sumi. They've got plants across the globe. So they've got the necessary experience, expertise, and the capabilities to execute work for Tesla. And of course, the one which you have mentioned, SKF, I think definitely they have plants across the globe and the necessary capabilities. Plus, another important factor is companies like SKF, they have focused a lot on localization too. At this point of time, if I'm not mistaken, the localization content is around 75%. So majority of the things are being made over here. And they can prove it to Tesla that they have the necessary capabilities to meet their order requirements. So that's the way I think we look at the entire scenario.
Okay, Kush Bora, some of these stocks have had a bit of an up move already. Anything within this set of 6, 7, 8 stocks? I mean, Tamanna was speaking about them in the trade setup as well. SKF, Sansera, Sona BLW, Samil. Anything that stands out for you?
So, a couple of them, Niraj. Minda has been, on the rise. There was a dip that was, quite smartly bought into. I think that is one stock that I will have on my radar. 800 plus kind of levels seem to be around the corner. Good support zone at about 700 levels. So risk reward ratio is also quite favorable. And also Sansera, the momentum here seems to be picking up. However, there's a small resistance at 1060 kind of level. So once that is taken out, I think 1200 is also a level that the stock can head to. So Minda and Sansera are two stocks that I will have on my radar from this space.
Minda and Sansera are on the radar. We haven't talked about the big one this morning, which is TCS. And of course, a lot of other stories that have been dominating the mind space. But Kush, let's come to the big one. Result season kicks off. TCS, the first on the block. And IT has been having a relatively pretty decent run. What would be your take on a TCS right now?
Not too convinced about the move. If I'm looking at a long-term kind of medium to a long-term kind of an investment bet, perhaps, given the history, I might still invest. But from a momentum perspective, we are seeing supply pressure time and again. So the way I would play it is, one, I would have it on my wait and watch list. Any kind of dip, let's say towards 3800 levels, perhaps, support zone, so a buying opportunity. And on the upside, if I get those 4100 odd levels, I will look to book profit and exit. So from a momentum perspective, I don't see too big an up move. So I will perhaps, look for other sectors. In fact, interestingly, that's the kind of setup that we are looking at in a couple of other big names also, be it Infosys, TCS, HCL Tech rather, and Wipro, was showing some promise and hasn't really delivered. So this is only a momentum play if a positive result comes out. But even then, I will take that opportunity to book profits around 4,100 odd levels.
Infosys this morning and strong moves, at least in the first few minutes of opening. Nirav, any take on your tech pack and TCS specifically?
Yeah, so I expect TCS to have a relatively better commentary. I think commentary will be the important factor to watch out for. If you remember during the previous quarter, TCS had said that they will look forward to some important factors like what is going to be the pent-up demand going forward, what is going to be the approach of the clients with respect to spending, because the current focus of the clients has been on cost optimization strategies. They are looking at such models which help them to control their cost, and discretionary spending has taken a backseat. But during this crucial period, we've seen TCS, they have built up their capabilities in generative AI, that is artificial intelligence. So they're doing a lot of work over there. The second important factor is that in the domestic markets, there's been a lot of traction on cloud migration. So there are a lot of things which are happening. During the previous quarter, they have signed some important deals with respect to vendor consolidation and the operational models as well. So a lot of things are happening in the background. We have to see what TCS has to say with respect to this. And they had indicated one very important thing, that optimization of subcontracting cost is a lever. It is an important lever to look forward to as far as the margins are concerned. So they are looking forward to improving their margins in FY25. That will be a very important factor to watch out for. They have indicated that BFSI is likely to bottom out in the last quarter of FY24. So we have to see what they have to say on that front. But overall, I think it's not as bad as it seems. I think we should have a reasonably good commentary coming in from TCS, and that should reflect on valuations going forward.
Okay. Well, so that's on IT, of course, but there is beyond IT as well, some stuff. In fact, a slew of brokerage reports that have come in this morning. There's Macquarie on ABB. We've spoken about CLSA on PVR broadly, but I think Harsh will join in to talk about that as well, because I think it could be one of the handpicked reports that he would have looked at this morning. Harsh, am I right? Is CLSA on PVR featuring on your list?
Well, yes, it does, Niraj. You're right. So first off, with regard to PVR itself, they've retained a buy. Target price is 2280. 65% upside from here is what CLSA talks about with regard to PVR. And what they're suggesting is they are expecting the sector leader to continue to consolidate, which is PVR, and that they believe will drive the numbers for PVR going forward. Multiplexes occupancy should rebuild in the mid to long term as multiplexes continue to grow, is what they are suggesting. They're thinking of the current content challenge not being a structural issue, and they believe that Inox's near-term ticket pricing and margins will continue to aid numbers going forward as well. The company plans to add around 150 to 160 screens every year, which will support growth, and therefore quite bullish on the numbers overall with regard to PVR Inox. They're expecting average ticket prices to be within that 250 to 260 kind of price band in FY25 and 26. That's the kind of number that they are building in with regard to PVR Inox, and therefore super bullish on this one. The other one is Newland Labs. We have Goldman Sachs initiating coverage on Syngene, Newland Labs. Two positive notes, but I'll talk about Newland Labs in particular. 9100 is the target price, 46% upside from here. Certain challenges in FY25 on account of higher base. Multiple other catalysts, though, to support the numbers overall. They're expecting improving biotech funding environment. They're expecting new capacity from one of their units to come online by FY25 end, and they're expecting commercialization of a large molecule in FY26 or 27. So some of those levers to aid the numbers for Newland Labs going forward, and that is possibly going to support the upside. Already up nearly 6% in pre-open, so definitely indicating that positive start. Key risks for Newland Labs, it believes, is going to be product concentration, vendor consolidation, and regulatory compliance. So outside of that, they're quite bullish on Newland Labs as well.
Okay. Well, CDMO, CRO, and Syngene, Newland feature in that list. Harsh, thanks for that. Laurus is a sell, according to them. Remember, Laurus has been a rank outperformer in the recent past. There's an antique note which said that they will do 22% margins possibly in Q4, which would be a big deal, and which is why Laurus has done well. But it's reflecting in the stock, by the way, 4% lower, presumably because of this note from Goldman. I wonder if Newland has reacted. Maybe, I'm sure we showed the stock while Harsh was talking. 5.5% higher for this one, so pretty strong show. Kush, coming on this one, technically, Laurus and Newland, because both of them have been in action in the recent past. Even a Divi's maybe, which corrected in Wednesday's session, but otherwise had a bit of an up move.
So Newland is opening at the resistance level, so I won't go and chase the momentum from here on. Perhaps another dip towards the 6,300, 6,350 mark, might warrant a buy, but not at the current level. Now, Laurus, as you said, yes, the stock has actually done well. It's trading above its key averages. The resistance zones have been taken out, and the stock sustaining above them. So I think that this dip might present a good buying opportunity. I don't see too much of a worry. The 440 level where it's opening is actually quite a strong support zone. So I think any kind of dip here, if it does sustain, for the initial 15-20 minutes, should turn out to be a buying opportunity. And as far as Divi's goes, well, this stock's been very volatile. So for me, from a positional standpoint, I'd give it a miss.
Okay. So that's the view. I mean, really, and we're seeing those reactions on Laurus and this thing already. Okay, quick one. Niraj, amongst the stocks in news, I wonder if Phoenix Mills has reacted at all to the monthly update. But did you like the update? I mean, 27%, 32% uptick in consumption retail sales. Premiumization is doing well, supposedly.
Yes, I have indicated earlier also that premiumization is the space to watch out for. So whether it is premiumization or luxury goods sales, etc., they're bound to do well. We've seen this kind of deep divergence in the markets. And I think it's a very, very strong update, and Phoenix Mills definitely should do well.
So Phoenix Mills doing well this morning. Realty also not doing too badly. Overall, as the pre-open rates have settled, I must say that not too much of panic, at least in the pre-open session, being seen on what we've been discussing all morning and highlighting in terms of the Mauritius FPI treaty, perhaps the street waiting to understand what the full extent of the implications are. But in the first glance, you were saying that maybe banks are having a bit of a weak day. HDFC, Kotak, Axis, those responding quite poorly. Now, I just want to get Kush's take on the BFSI space and anything that you'd pick right now. Kush, anything on your radar?
So, we do believe that there is a lot of momentum, that is yet to catch up in the banking space. So I think that is one space that you should have on your radar. From, a stock-specific standpoint, we're looking at a PNB. The stock's actually trading above its resistance zones, although consolidating here for the last couple of sessions, but the buy here is positive. So any kind of dip, will turn out to be a buying opportunity in PNB. Geo, time and again, we've discussed. So, you even at the risk of repetition, I would suggest, any kind of dip here towards those, 350, 360 zones will be an excellent opportunity. But that is if you get that, anytime soon. So, Geo and PNB, are two stocks that I have on my radar from, the BFSI space. But, again, HDFC Bank is something that I will not discuss again. We've time and again recommended that this stock is likely to go to 1700 levels. So, that's not something that I want to discuss again. But Geo and PNB is something someone wants to trade from a near-term perspective. All
right. Sona BLW having a good morning. We talked about this earlier in our trade setup as well. Maybe it's the Tesla mood coming in. But Nirav, I'm going to ask you if you like the auto space overall or you're focusing on Auto Ank?
I think the primary preference is the auto pack. We've seen the auto numbers have been quite strong, and we've seen passenger vehicle demand. We've seen two-wheelers, three-wheelers continue to do quite well. Commercial vehicle is also in a good space. So overall, I think the auto pack continues to be the prime preference. And of course, selectively, we like auto ancillaries too, which we have already discussed, like stocks like Sona, BMW, or the likes of Motherson Sumi, or SKF, Bharat Forge, and the likes.
Okay, well, stay on, gentlemen. Lots more to talk about because the markets are about to start, and it'll be interesting to see what happens. By the way, remember, not just globally, even in India, the yields are inching higher. The 10-year yield in India is 7.17. So there is a bit of an uptick there too. BFSI could be under pressure today. More so public sector banks. We'll talk about that. The Nifty starts off lower, not as alarmingly low as was thought of, but 22,660 in line with what the 2-day move was suggesting in the global markets. Nifty Bank about 0.4. Nifty Metals and Nifty, mid caps faring a bit better. Wonder what small caps are doing. It's not as exaggerated, but this is not, I don't think these moves are anything to do with the Mauritius Treaty. It's got a lot more to do with what's happening across the world, currently at least. Like our guest said, maybe some clarifications on the anvil. Wonder if metals are doing well. That's just the one index that I want to pull before we go to the heat map. No, even metals are not. So clearly some pressure. Pull up the heat map. Lot more red, one would expect, very little green, and maybe the first row, if at all. Yep, just about that. A lot of red. Pharma starts off weak today again. So Sun Pharma down 2.5%. Dr. Reddy's down about 1%. We know Laurus Labs is sulking. Divi's was sulking day before. So clearly Pharma is not having a great time. Autos are pulling back, you have to admit. Maruti yet again is down about 1%. Yeah, this week earlier we've had some of the auto names pull back, so that's the other basket to watch out for. But Sun Pharma in particular down about 2.5%. What is doing well? NTPC again was up 3%, I believe, in Tuesday's session, and up another 1.5%. Tata Motors, some bit of green. Hero Moto. So actually, I stand corrected. Autos are a bit of a divided lot. Some autos are doing well. M&M2 in the green. And Divi's, interestingly, is in the green today. So much as it sulked in Wednesday's trade, in today's session, climbing back. Clearly, Tamanna, the newsmakers are at the broader end of the spectrum, but clearly something wrong with Sun Pharma. And on the right side, NTPC is really doing well.
NTPC consistently having that great run, as you marked, Niraj, and that is very, very apparent. But I just want to pull up what's happening on the broader indices before we get to specific stocks and look at what the mood is there. Completely flat, but at least in green territory compared to the Nifty and the Sensex. The small cap also not doing too badly. Let's talk about the stocks that we are tracking this morning. Metropolis is one of them, and good business updates from Metropolis, has seen that stock open quite smartly, about 6.5% up right now. Phoenix Mills, again, good retail numbers and collection numbers as well, both for the fourth quarter as well as for the full year. So both are doing well this morning. Vodafone Idea, story that we first reported, has been confirmed. I'm not seeing any movement there right now. Maybe something wrong with that. There you have that down about 1% because of that skepticism. Are you going to be able to raise 18,000 crores? PVR is the other one that we've been discussing, a completely very, very positive and perhaps over-optimistic report from CLSA. The stock not really moving, maybe the street not buying that story. CAMS was one that we were talking about. It's got an approval from the RBI to operate as an online payment aggregator. Big deal for them, actually, and that stock reflecting that mood, about 5% up right now on a CAMS. We were talking about this Goldman Sachs note on some of the pharma players, and we'll pull those up together and see what's happening there. Syngene, positive as the GS note suggested. They had a positive outlook on it. Newland was also about 5% up right now as we speak. Laurus Labs, meanwhile, seeing that negative outlook down about 3%. I'm just going to see if we can pull up Vodafone once again. That breaking news on your screen. A share price sale has been approved in the band of 10 to 11%. Very quickly, that stock responding negatively. The floor price of the offer at 10 rupees per share. So you're going to see a bit of negative, at least as of now, negative news flow and negative price action on Vodafone. But coming back to the point, Niraj, more than Mauritius FPI, there seems to be a sense of a bit of profit booking also weighing on the markets.
Yeah, most certainly, Tamanna. That's how it is. But 0.25% are not too badly behaved. But some stocks specifically. So Metropolis, we spoke about it. Debt repayment done 6% higher for Metropolis. 15% growth, debt free. That stock is reacting, is the best performer on the BSE 500. CAMS has reacted 4%. Hindustan Copper sees no red. Phoenix Mills, Tamanna would have marked 2.5% higher for that one. And a lot of these auto anchors, right? Jamna Auto, Uno Minda, Sona Comstar, Craftsman Auto, that whole bucket of stocks has done really well. Indus Tower is reacting to the positive news flow on Vodafone Idea. So that's the other thing which has done well. And my colleagues, like Tamanna said, broke the story on Wednesday, Smriti and Vishy. And that news make, while the pricing is having an impact on Vodafone, for Indus Tower, it's actually a positive. If Vodafone manages to do this 20,000 crores of equity fundraise and then subsequently maybe 20,000 crores of debt fundraise, that's a big positive for Indus Tower. So keep an eye out for that stock as well. And lastly, Entero. Jefferies has a note on Entero, and that stock is up about 15%. It's one of the big movers in the session today, so do watch out for that stock too. Last question, really, but Kush Bora, opening thoughts. We're not doing as badly. Is there an index trade? One, and is there a specific stock, even from amongst your recommendations, that you would initiate a trade on after seeing the open rates?
Sure. So, Niraj, actually, honestly speaking, I would have liked the Nifty to actually give that gap down opening off somehow about 100 odd points closer to the 220 to 600 support zone. That's not happened. I think from here on, what will happen is we'll consolidate. 20 to 700, give or take 50 points might remain the range, for the day. Truncated week coming up as well. So I think, the trade on the index is missing, at least on the Nifty. Bank Nifty might perhaps have a positive trade, but I'll wait for some more cues. So no trade on the indices for now, but the bias on Bank Nifty remains positive. A couple of trades that we discussed, Aarti Industries and NLC India, both had opened mildly in the red, but are trading in the green now. And, as far as a fresh trade goes, what I have on my radar is, the entire investing universe, where the likes of BSE, CDSL, a couple of broking names also are popping up. But the one stock that I like, after the opening is CDSL. There was a resistance at the 1900 band for the last week, maybe even 7-8 trading sessions. The stock's taken that out, this morning, sustaining comfortably above that. So I think 2020 is the first target, and then perhaps 2100. So positionally, these are the levels that I would track on CDSL, and 1860 becomes a strong support zone.
Metropolis is the stock of the morning, 7% up now. Nirav, just a quick take post open on Metropolis or anything else that you're spotting?
Yeah, I think Metropolis, a very good update which we have received, and as you rightly pointed out, that expect the margins also to improve going forward, repayment of debt, etc. So I think these are all positive triggers as far as this diagnostic company is concerned. But overall, I think, as I've pointed out earlier, we like the hospital space more. But I think these diagnostic companies are also catching up in terms of valuations.
Okay, well, 7% higher for Metropolis and doing really well. So do watch out for this one. Take a moment, Kush Bora and Niraj, to thank you for joining in today and giving us that perspective. Now, just get a quick perspective from somebody on the developments that have happened in the last 24 to 36 hours. First, the US CPI print that Tamanna spoke about on open, rather on the trade setup. And Uday Kotak gave out his views in a form of a post on X. And he says that US inflation is higher than expected. This postpones US rate cuts to later, closer to the US presidential elections, if at all. Brent oil now at 90. And I think, therefore, that means that this will keep rates higher for longer worldwide, including India, the only white card, China imploding economically, by the way, which will not be good news either. So get ready for global turbulence. Effectively, amongst the best quote-unquote analysts saying that don't expect rate cuts before November or October, that is some saying really. So that is one. And a key thing that Uday Kotak brings out, that be ready for global turbulence. So that is part one. Anything there? And then, of course, this whole tax thing. So I think we should make our viewers aware of the conversation that we've had already with two experts.
Yeah, we have got some great points from two excellent experts. 8:15 this morning. If you didn't tune in, this is where you get to hear a sum of what they're saying. The way that this needs to be diffused is essentially by some kind of a clarification coming out on what will be the scope of impact and whether it will be retrospective. Just a quick 10-second recap. The new rules from the government say that you have to prove, if you're a Mauritius-based entity, that you're not there just because there are better tax rules in Mauritius, but that you existed much before you started investing as an FPI in Indian equities. Listen in to what our top experts said this morning.
So two parts to it. First of all, India is a party to the OECD amendments, and one of the amendments is that every investment into using a treaty should, as Pranav was explaining, meet the principal purpose test, meaning thereby that if you are using the treaty of another country only for availing tax benefits, then the treaty should be denied to you. So if there is a US investor using a Mauritius treaty to invest into India, and the principal purpose of that is found to be only to avoid taxes which are legitimately avoidable under Mauritius-India treaty, then the treaty benefits can be denied. Now, this principal purpose test is something which India has been renegotiating several treaties, and in several treaties it has been there. Mauritius is now going ahead and implementing. I think the real point is the point which Pranav mentioned in the passing, which is the applicability of the treaty. The wordings of the protocol which has been entered into to amend the treaty suggest that this amendment will apply to all existing investments and to all the past years. And that is not while that is not very happily worded, knowing how the tax office is likely to implement it is to go back and say that even if your investments were made way back in time, if the examination of that investment is coming up now, we will apply the principal purpose test. We will not grant you grandfathering, and therefore to that extent you are open and vulnerable to a tax payment in India. So to that extent, all FPIs could get very significantly impacted as a result of this amendment.
So let me put it this way to make it very clear. I don't think I expect a clarification that all investments which are made up to the date of the protocol signing will not be impacted. What I do expect is that all sales, any capital gain accruing arising on a sale after the date of the protocol being signed and becoming effective are only impacted, and not any exits, any capital gains arising before the date of the protocol. So I don't expect that investments made only after the date of signing of the protocol will be impacted. Even investments made before the date of signing of the protocol will be impacted, so long as the exit or the capital gain event arises after the date of the signing of the protocol. That is the clarification that I expect will be made, and that I think is the intention. But since I heard Mr. Kanabar saying only impacts investments made after the date of signing of the protocol, to clarify, that's not what I meant. At least I don't anticipate that coming through. That's one. And if that happens, then I would, and second, I expect that if an investment was made before March 2017, then whenever the exit happens, it will always stay grandfathered. That is the second clarification that I would hope to receive. So that's where we are. And if both these are received, I think largely the impact would be minimal. It would then impact very few investments made before March 2017, which also would be then grandfathered. So it would really impact maybe units, etc., holders who are not holding shares, but who still have public market impact. That then would be very limited, I think, of this protocol.
Okay, and I think this is important to just get a perspective of somebody who looks at it from an outside lens. Santosh Rao, Head of Research and Partner at Manhattan Venture Partners, joins us right now with a quick perspective on this one as well. Santosh, great having you. Thanks for staying up late for us.
No problem.
But is this a big impact, or as the tax experts suggested, that if the clarification around retrospective amendments not being applicable, if it comes about, that is, if that does happen, then it kind of mitigates the impact of this. What's your sense?
Yes, it does. I think the key thing is clarification, consistency, clarity, and you don't change the rules of the game, middle of the game. So I think foreign investors want some consistency and clarity. So I think that's where it'll impact. I think at this one, I think overall, it seems fair to do that, but the net, you don't want the grandfather thing. I don't want to go into the technical aspect. I'm not a lawyer, a tax lawyer, but I think overall for a foreign investor, I just want to make sure that whatever was done, if it's unfair, that's fine. I mean, just definitely go ahead, tax them. But overall, if you just can't change, you can't say this was the rule and then go back and then impose all these big penalties. So I think that's where the thing becomes very dicey. You don't want that, because the one big thing, and one thing going for India is that it's a big, India is doing great. The economy is great. Money is pouring in. Everybody wants to be there. So that's going there. So I think at the margins, maybe you'll have some impact. But overall, I think India will still be a destination for a lot of foreign funds. So I think in the margins, I expect some corrosion here and there. But net, I think it'll be okay with some clarification.
Santosh, good evening to you. Good morning for us. And thank you for joining us from New York. This is Tamanna here. I just want to get a sense of the significance of the Mauritius route for foreign investors. What we see is that perhaps the importance or the use of that Mauritius route has been diminishing over time. So can you put that into context when we talk about these latest rules? And is that why it's not such a big deal, at least in the first reaction we've seen on the markets open?
Yeah, I mean, I was looking it up. I think only 6 billion comes in from Mauritius. I think Singapore is the largest. I think 17 billion comes from Singapore. So I think it's a small part of the overall. The main thing going for India is that 70% of the GDP is all consumption based. So you're not really depending on any foreign funds coming in, but it's good to have it. And if we are aiming to be, or if India is aiming to be the third largest economy in about 10, 20 years, so you really want you want to fire on all cylinders, essentially. So I think you need all the funding in there. It's good for liquidity come in. So I think it's good to have Mauritius and other outside centers to all these tax benefit centers, but it has to be fair. And that's what you're going to see. There's some clarity. I think India knows that it's the destination for all the funds. It needs solid tax laws so that nobody games the system and takes advantage of India.
Correct. Just coming back to the earlier point you made, Mr. Rao, about how attractive India is as a destination. Now, at least through the calendar year of 2024, we've not seen this big barrage of funds. 2023 was exceptional in that sense, especially over the last 2 or 3 months. Is there a wait and watch before June 4th, when the election results will be announced for the next government and the next 5 years? Do you think investors are sitting on the sidelines just waiting for that event to be behind them?
Absolutely. They are. And there are U.S. elections also. The U.S. is the biggest. A lot of money comes from the U.S. So I think, and there's so many elections going on all over the world. So everybody's in a wait and see mode at this point. So you'll see a floodgate of money flowing in and out after the June elections in your case, and November in our case. So you're going to see tremendous activity after that. So definitely, and that happens every time. There is some pause before the elections, and after the elections, you have some clarity. So I don't blame any big investors to hold off and see where the dust settles and see where which government is coming to power, essentially.
From the Indian context, though, I presume that June 4th would be more relevant, and you will see maybe some activity post that?
Absolutely. I think looking at the polls and all that and reading about the elections, I think it's essentially given that Narendra Modi will be the next prime minister. So if there's a big surprise, I think that's going to be a net negative. But at this point, the way India is growing, the things are the way they're flowing right now, you don't want any disruption at this point. So I think the majority of the people expect India to do well after the elections. But any incremental dollars coming in, I'm sure the investor is holding off to see, just in case something happens. So I think that's the logic. I would say if I was an investor, I would do that. I would wait and see. But in this case, in this election year, there is much better clarity as to who's going to be the prime minister. So that really helps India's cause.
Okay. Santosh, just one last question from mine at least. Can something upset the apple cart? Crude price uptake or yields going up and rates not coming in? Uday Kotak is saying no rate cuts until November at the very least, or something else.
You're talking about the US market?
Yes. I mean, no, but what the US markets do, I mean, the world will follow, right?
Absolutely, it does. They really lead the whole world. I think what's happening is we've got three hot numbers. Inflation numbers. That's kind of put a damper on this glide path to 2% that the Fed wants to see. So I think that's been a slight change, but a lot of things going in favor of the Fed. Instead, the market is doing, the bond yields going up, dollar going up, and a lot of things, oil prices going up. A lot of things are limiting the economic growth. So the Fed should take comfort that the market is doing a lot of its work, even though inflation is not going down as fast as they want. So you're going to see some setback. I think overall, I think the market is going to adjust. The June cut is definitely off the table. So I always expected 2 for the year. So I think you're going to see at least 1 in July and maybe 1 later on in the end of the year. So I think that's my take, 2 this year, but definitely June is off the table.
Now, it's interesting how we've progressively moved that from no March to no June to now saying November. Let's see what happens by then. But for now, we leave it at it. Thank you so much, Santosh Rao, for joining us and giving us your perspective this morning. Markets, meanwhile, I would say fairly settling. NTPC and the PSE pack is, the star of the day. NTPC, BEL. Tata Motors also not doing too badly. Let's pull up Tata Motors. They are tying up with Shell, and they're going to be establishing EV charging stations across the country. That's actually a big one, and will add a lot of, I would say, boost to that whole big question of where is the EV charging infrastructure. So it would be great to get more detail on what the extent of those plans are and which cities they're coming into, but there's a partnership with Shell there. Sun Pharma is seeing a bit of a downtick this morning, and it's largely because of this news that the US FDA has conducted an inspection at the company's Dadra facility. Subsequently, they've determined that the inspection classification status is OAI. So that's official action indicated. That's a negative, but you've seen it come off its lows of the day, and a bit of maybe recovery there. We were talking earlier about the Tesla beneficiaries, and I find that story very interesting. A Sona BLW doing well, a clutch of other auto anchors also doing very well, Niraj, but Metropolis again, the start this morning. Most certainly, but I mean, that's the nail on the head really. And Antero on the brokerage note notwithstanding, these are the ones that matter. I mean, and look at the kind of gains that some of these stocks have had today. Time for a break. On the other side, Gaurav Pandey of Godrej Properties in conversation with Tamanna. Stay tuned. A stock in focus, a sector in focus, and a company in focus is, of course, Godrej Properties. While all of real estate has really been seeing this upcycle, Godrej Properties in particular has hit the headlines for a couple of reasons. First of all, very, very strong numbers in their Q4 business updates. Then a positive Jefferies note. Other notes as well talking about the real estate space and highlighting Godrej Properties as one of the strongest listed players. So what's really cooking here and why is this working? To speak more on that, I'm joined today by Gaurav Pandey, who's MD and CEO, Godrej Properties. Great to have you on NDTV Profit, Gaurav. And, to speak with you on what's happening with the business. Yeah. So let's begin with...
Sure, looking forward to, please.
Absolutely. Let's begin with what your Q4 updates are saying and why that's been so exciting. One, you've exceeded your revised guidance of 20,000 crore rupees in your bookings. They are, in fact, 61% above the guidance you provided at the start of the last financial year of FY24. You've had highest ever quarterly sales of 4,000 crore rupees in MMR, and your overall bookings have been 84% up year on year. What's happened in quarter four?
I think it's a combination of a lot of efforts. Tamanna, thank you so much for having me in the show. It's a combination of a lot of efforts over the last many quarters, which has kind of brought us here. Just a bit of a, sort of a story. I mean, if you see at 9 months, as you rightly said, we were doing fairly well. In fact, we were higher than the last year number by December end. We were like about 13,000 odd crores and something like a 6%, if my memory serves me right, higher than last full year's number. So we had a very strong foundation to start with. In fact, I was frankly even resisting to give any revised guidance, but we did share that about something like 18,000 crores is what we were anyways hoping that we will hit, with some launches, thought as a planned part of the planned calendar for Q4. But I think, it's the combination of great product market fit, having a very strong strategy, but great execution excellence, which finally leads to better numbers. So, of course, feels delighted that Godrej Properties, of all the results that have been declared yet by any listed developer, GPL is stacking up. But I think it's more than numbers, the rigor, passion, commitment of our teams. And through that, we've been able to deliver a 22,500 plus crores kind of a sales figure, which is, as you rightly said, about 84% higher than last year's number. And this is the first time, in quarter four, we've done 9,500 crores, which is the highest booking value generated by any real estate developer till date. So something we take a lot of pride on in terms of resilience, that, there's an internal saying that it took us 13 years to reach $1 billion worth of sales, and just took us 1 quarter to do more than that this sort of financial year. So feels very excited. Of course, the entire portfolio is very, very strong. And I think this is just the start of the opportunity that lies ahead for us, because our business development has been very, very strong in the last 18-20 months. So yes, we're looking forward to continuing the growth momentum.
Are you upping the guidance for FY25 on collections? And, definitely in terms of bookings, anything that you can share? Are we waiting for an eye-popping number for your FY25 guidance?
I think FY25 guidance, frankly, we've not really decided yet. I think we have a board meeting coming up next month, and likely we will think through what are the kind of guidance we want to give. Our approach to guidance is a little different. We always give what we are more than confident, so that there is no speculative estimation done by any of our valued investors. But yes, next month is going to be entire results will get declared. And all I can say directionally, more than a particular quarter or a year, I think what is very exciting to notice about us is we're the only platform which is present across 4 major geographies in India. So our ability to scale up when we want to scale up is a more of a method-based approach than just a market opportunity alone. So I think we are looking more consistent sort of a growth across markets, and probably by May we'll have a very specific view about any guidance that we may want to share then.
Okay, fair enough. I mean, I think the street would be penciling in definitely an uptick from what your current guidance is. But one guidance which is in the public domain is your collections to end this financial year, which is about 10,000 crore rupees. Is it still that figure, or was that revised upwards? If I look at the 9-month figure that you've put out, then you need to hit around 3,000 odd, a little more than 3,000 odd crores in Q4 to hit that 10,000 mark. Are you on the path to doing that?
Again, this would be, frankly, because our results on the collections are yet to be out. But, what we did communicate even in the last earning calls that, Q4 was expected to be a, sort of a well-rounded quarter. I would just say that, please wait for about, say, 3 odd weeks and all these residual figures will also come out. Because as we speak, these are the last details, and I think you would appreciate, being a listed company, we've not declared these numbers yet. But fair to say that, I think over a period of time, whenever we've committed something, we've tried, our endeavor always has been, to give a holistic performance. And maybe 3 weeks from now, one could actually assess our overall performance.
Yeah, I'm going to hold you to that, and hopefully we'll speak again 3 weeks from now. On the face of it, of course, things are looking good from what we've seen so far. Can you give us a sense, Mr. Pandey, of what your average price realizations have been? Because I know the mix is more towards the premium side and the luxury side. So what does that put your average price realizations at?
It's very frankly offhand, I don't have that number yet. But yes, your thesis is largely right that yes, there is a sort of a portfolio premiumization which has happened. Because if you see, we were a developer focused on a type of projects and locations few years back, very consciously and with a lot of rigor. The last, say, 25, 26 transactions have been very, very focused on city-centric, high-quality locations. And frankly, the premiumization is an outcome of the location matrix. So yes, if you look at Mumbai, for an example, the big number that came in this quarter was from a Kandivali launch. If you look at the north, also is a prime sector, Sector 89, and so it goes for all the locations. But yes, I don't have the number offhand right now in terms of what is the per square feet average realization that we would have achieved. But yes, fair to say that it's a quite a directionally upward ballpark. If you ask me, we've done, say, 9,500 crores and 20 and overall year, say, about 22,500 crores at 20 million square feet. Offhand, you can take a number. It may not be very accurate, but you get a sense that this is the per square feet average realization. But yes, very happy on the overall sales quality of performance as well as the overall margin profile that we're able to deliver from this premiumization.
Yeah, with real estate companies generally, and when you look at the business, and of course you're the one looking at the numbers day in and day out, Mr. Pandey, but when it comes to margins, that's where things get tricky. There is appetite in the market, there is push to expand. In terms of margins, are you feeling comfort where you are at? I know you're not really going to give me a guidance. Street's expecting 15 to 18% over the next 3 to 4 years. You may not want to give me a number there, but I just want to understand if there is comfort there with input and material costs not hurting as much, or a willingness to pay for it.
I think that's a great question. See, if you see real estate business from margin profile is dependent on a couple of variables, right? Land cost, which is frankly inflation agnostic once you lock in a price. Then you have other costs in COC, which is cost of construction and people that you hire for a project, and marketing and brokerage. Of this, somewhat is inflationary led and somewhat is again fairly reasonable to estimate. So at a ballpark, when you see the cost stack up in the entire P&L, there's a reasonable portion which has inflation risk, but largely it's fairly easier to predict. And then on the revenue side, you have the top line, and then the residual is your margin. Now, incidentally, if you see the cost pressures were very high post-COVID, the first year, because there was a sort of a supply shock and cost did move up. But fortunately for us, if you see, we did a massive BD expansion post-COVID. We had the capital, but we didn't do much of transactions pre-COVID. We had a massive BD expansion, say about 18-20 months back onwards. And I think if you see, that was as perfect as you can get. Why? Because your estimation of cost, because you had to be conservative, because you were coming out of a hyperinflation environment. So we estimated cost to say some amount of overestimation on the cost so as to protect the downside risk. But the market was not as hot as it is today from a price realization point of view. So we were very realistic to what we thought, which today, if you see by standards, very conservative. And a combination of that, I think, is a bit of a luck and execution excellence and some strategy. I think it's a combination of that. So margin expansion has been phenomenal for us. Of course, we don't give that guidance and all, but I think it's easier to see that we're one of the few developers which is selling in volumes. In record booking value numbers, but what is more heartening is try and see our payment plans. These are payment plans which are very, very high quality, creating great cash flows. You try and see our price realization to micro market average and near competitors. Usually we're the best in class. So I think it's a combination of that, and we're more method than madness. So I think if you follow method, you finally will see outcomes sooner than later. So yeah, overall margin expansion has happened. And I think if we continue with great, robust cost management, asset management, I think then, when the accounting will allow us to recognize them as and when the OCs will come, you should see that in our P&L as well.
So that method over madness approach is what has, one presumes, led you to Hyderabad. Talk to us about, where that goes and what you expect to see out of the Hyderabad market. What are the other markets that you now are penciling in over the next several months?
See, Hyderabad is been in our radar for a fairly long amount of time. We had studied the market very well. Then, as you would know, there were some auctions which were done in Hyderabad, and we got a sort of a fair market valuation. And when we were on the private land side, we were able to hunt for great land investments which were sort of a discount to the fair market value that we were able to kind of stitch. We decided to go for sort of a Hyderabad big bang market entry strategy, which is what you're seeing right now. And the thesis is very simple. In fact, if you again take data with a pinch of salt basis what any research report one can rely upon, but the large data that suggests is that Hyderabad has actually crossed Bangalore residential real estate market size, which is quite phenomenal because one, Bangalore itself is a huge market, and in Hyderabad there are very, very few developers who are pan-India or even zonal, South India focused, handful of them. So it's the local market itself which is so hot. So I think it's a huge opportunity for a brand like us. And the funny thing is, the day we announced land transaction, I got actually emails from prospect customers saying, when is the launch happening? And I was delighted to read those kind of emails as well. So I think it's just a market has a huge depth. There's a great opportunity for us to create an impact, and we're very excited about that.
Seriously, that is interesting that you acquire land and there are already people asking about where the project is. Can you give me a sense, though, whether you see that kind of appetite sustaining? And this is sort of, I think, the fly in the ointment from a longer term outlook. It's premium that's selling, so maybe volumes compared to the average might not be that much higher. How long will that appetite remain?
Try and see the larger picture. India is like of course, to say about $4 trillion GDP. It's going to become $7.5 trillion by 2030. By 2047, it might become a $30 to $35 trillion sort of an economy. Look at current urbanization rate; it's about 32%. China is 62%. US about 82%. Try and see what is happening at the upper market. Income growth. It's become double of sorts. You look at Goldman Sachs Affluent India report. People who are adding to the value in terms of wealth aggregation play is one of the most unprecedented levels. So I think combination of this, is a game which the market size and the overall economy will do well. And you buy houses because you feel confident about your jobs and your own wealth creation in the long term. So I'm a very strong bullish person on it. Of course, real estate is cyclical in its own tendency, so you will always have continued booms and some periods of of opportunities which may not be as exciting. But I think try and see where are we right now. I think in spite of the massive growth, we're still not really scratching the surface. Any large residential development today, I think we happen to be the largest, is about give or take 1 or 2% here. There will be like 3 to 6% in any market we kind of operate on. And look at any sector which has become organized. You have market leaders in high double-digit kind of numbers. So I think fair to say from a directional 10-year view, we would definitely grow leaps and bounds, backed by a very strong economic thesis, strong business model, and the opportunity that lies ahead of us. So yes, I'm reasonably very confident that the cycle is there and we'll make the best out of it.
Back with NDTV Profit, and we are looking at a market which is slightly skittish today, but amidst all of that, global flip-flops, we have a new, I wouldn't call it a kid on the block, but a new listing for sure, Bharti Hexacom. The issue was subscribed about 29.8, so nearly 30 times. Just ahead of the listing, we had a couple of brokerages come out with a fairly bullish note on the stock as well. Let's see how it's listing. It's listed at a price of 755 or 756, which is about a 32% premium. This exhausts the premium that JM Financial in the early morning note that we were talking about wrote on the stock as well. So lists at a premium, was on expected lines, and I think it'll be topical to talk about today as well. But keep in mind that Telecom is the flavor of the week, if you will, if not the season, and everything linked to that as well in some fashion or the other also becomes important. But independent of that, Bharti Hexacom, strong listing, and good to see a strong listing. For a brief bit, we had stopped seeing these, stopped seeing the upticks, and we don't want mammoth upticks on listings also, but this is a good listing. And let's see how it shapes up during the course of the day. But viewers, thanks for tuning in to Talking Point. I'm your host, Niraj Shah. And I want to start the show with something that Uday Kotak put out on the social media platform X yesterday, wherein he spoke about how, because of the inflation print that has come out, rate cuts get pushed to the very least at November, globally, including India. Maybe they coincide with the US elections, which makes the whole piece very, very interesting, if you will. I'm not saying it verbatim, but that's the implication of that tweet. And I reckon that he mentioned that get ready for global turbulence. And now, it's pertinent because that is what seemingly is happening over the last 48 hours. Geopolitics, crude, equity markets being very choppy, and gold, a lead indicator of what the safety prognosis of the investing world might be, knocking on new highs yet again. Somebody who is best placed to correlate all of this and bring the Indian context as well is Devina Mehra, founder and chairperson and MD of First Global. And it's absolute delight to have Devina in our studios. Devina, thanks so much for being here.
Thank you, Niraj, for having me.
No, the pleasure is entirely ours, I must say. Devina, I just wonder though, would investors by and large have a fairly pleasurable next few months, or are there clouds on the horizon?
So you're talking globally or India?
Globally. Let's start with global. I would love to talk global with you first.
Right. So globally, I'm quite positive on the equity side. I was a little more nervous middle of last year when the entire move was very, very tech-led. If you look at US, for instance, from January to October 2023, not just a NASDAQ, which is anyway a tech index, S&P 90% of the move was only 7 stocks, 89% to be exact. And most companies, most stocks underperformed. I mean, they were, I think, something like 70% which were down. So it was very, very skewed. So it's always scary when the markets are that narrow. But thereafter, they started to broaden, and which is playing